Will your taxes be higher in retirement? So in this video, I'm going to share with you 4 reasons why your taxes might be higher in retirement. And the key word there is might, because I think a lot of people are led to believe that their taxes will be higher or a lot higher once they retire. But oftentimes I found over the years that that's not actually the case. So with that, let's talk about it and dive into reason number 1 as to why your taxes might be higher if you have saved successfully over the years. So specifically what I mean by that is that if you have done a really good job of saving and investing, perhaps in your company's 401k plan, or maybe it's a 403b or 457, depending upon where you might have worked. Maybe you have an IRA now, whatever it is, any type of account that you funded on a pre-tax basis, that now when you go to withdraw that money, you're going to have to, that money is going to be subject to ordinary income tax. That could then potentially put you in a position where you might have to pay more in taxes in retirement than you did in your working years. Now, that said, though, if you have other sources of income that's available to you, maybe you have a Roth IRA, for instance, which you could tap into tax-free. Maybe you have a taxable account where you could exercise long-term capital gains, which are taxed at a lower rate, and you could blend the source of the money that you're going to withdraw in such a way that you could actually put yourself in a position where you don't pay more in taxes, and perhaps you even pay less depending upon what's there. So that's reason number 1. If you've done a super good job of saving and investing, you have all this money that's in these accounts, again, it's going to be subject to ordinary income tax. The second reason why your taxes might be higher in retirement has to do with required minimum distributions, or RMDs for short. Now, this still kind of falls in line with the first one, right? We're still talking about withdrawing money out of these pre-tax retirement accounts. Yet the difference here is now these are the mandatory minimums that the IRS says, hey, look, even if you don't want or need the money, we're going to require you to take out a certain amount of these accounts every single year once you hit your RMD age, which is age 73. And then, of course, that money that you withdraw is subject to ordinary income tax. And so you could be paying taxes unnecessarily as a result of that. It could also cause some of your Social Security benefits to become taxable that may not have been taxable otherwise. It could cause an IRMA surcharge. These are the increased costs that you have to pay for Medicare, depending upon where you fall within those brackets for IRMA. And so there's all these different unintended types of things that could end up happening here as a result that could cause you perhaps to have to pay more in income tax. And the third reason why your taxes could go up in retirement is simply because tax rates are set to increase. So the Tax Cuts and Jobs Act, which was signed back in 2017, is set to sunset at the end of 2025. And so what that means is that in 2026, if nothing changes between now and then, we will go back to the old higher tax rates. Now, based upon the results of the most recent election, there's a lot of speculation that the Tax Cuts and Jobs Act could get extended. So we'll just have to wait and see how all that pans out. But here's the other thing that I want to mention here is that, keep in mind, even if tax rates go up or tax brackets get thinner, we go back to the old tax rate, whatever it might be, that doesn't necessarily mean that the amount of taxes that you have to pay will go up. Keep in mind, if you're in your working years, your primary income, at least for most folks, is coming from your paycheck, right? So you have to pay federal taxes, maybe state taxes, depending on what state that you're in. You have to pay FICA taxes, right? Payroll taxes. In retirement, you're not paying payroll taxes. That goes out the window. And also, you may have money that's coming from a Roth IRA. That could be taken out tax-free. Social Security, even if you make $10 million a year, only 85% of that could be subject to tax, right? So and then you get capital gains, which are taxed at a lower tax rate. So the source of your income in retirement can play a huge role on the amount of taxes that you have to pay. And that's why it's so important to do tax planning and think through when you're going to withdraw money from certain accounts and when, in order to help minimize the taxes you have to pay. And the fourth and final reason here today as to why your taxes might go up in retirement is simply because of our national debt. We are more in debt than we've ever been in the history of our country. We're sitting right now at about $36 trillion as I'm recording this here today, and that number is continuing to grow. And so, who knows? There's a lot of speculation as to what could happen. Perhaps some benefits get reduced. Perhaps taxes get raised as a result of this in order to help get more revenue. Again, there's a lot of speculation. I'm going to leave it at that. Hope this has been helpful. If you've gotten value out of this video, make sure that you like it. Make sure you subscribe, and I will see you soon.